Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham. This is episode 28. And on this episode, the Fed giveth and the Fed taketh away. So we're going to talk about the Fed meeting that we had just a couple days ago, how the markets are reacting to that, how you can reposition your portfolio based on what the Fed thinks is going to happen to interest rates over the next year, couple years, and really kind of right-sizing your portfolio based on that. We're going to talk about some of the goals that we discussed and really just give you a general update on this holiday week. So thanks for joining me, and I'll see you on the other side. Okay, well, welcome back to the program. Appreciate you being here as always. And just kind of go over a couple things that we had talked about last week. I talked about having a couple of y'all come on to talk about your goals for 2022. I'm excited to say I already got like 5 or 6 of y'all lined up to come on and discuss your goals. So that's going to be a fun episode. I'm truly looking forward to that. A couple other things I said that I might be listening to, or I might read that new Will Smith autobiography, and I've already started on that. So that was going to be one of my books for 2022, but I've already started on it. I'm about 4 chapters in. I am listening to it on Audible, so I am doing the audio version, which I got to say is pretty amazing. Will Smith actually reads it. He actually sings in it. He does a lot of really fun stuff that you probably wouldn't get if you're actually reading the book. So I say that because obviously you're listening to me now, so you might like that audio, the audio format. So Audible is a great place to be able to download a lot of books, have really good readers. But the new Will Smith, it's pretty good. The first of it's actually really, really good. So you might want to put that on your list. So as we get into this week, we have a lot more volatility than we've seen in the past. Where we saw the Fed meeting on Wednesday, where Jerome Powell came out and said that they're going to double the speed of them tapering bonds, which means they're going to buy less bonds to support the market. And they're going to be done doing that by the end of March, right? So they're going to be done tapering. They'll be done buying bonds by the end of March. And so what that does is that it frees them up when they're done with that to be able to start raising interest rates. And so right now the plan is, 2 to 3 interest rate raises next year, and at the end of 2022 to have interest rates be somewhere around 0.9, so right below 1%. Now, there's a lot of things that can change that. Unemployment's one of the big ones. If we start having higher unemployment, if more coronavirus cases, if things go back into lockdown or whatever. I mean, it's too early to tell. This week there's a lot of coronavirus cases and whatnot. So we'll have to see how that goes. I don't think there'll be lockdowns. I think we just learned to manage this. But those are the kind of factors that are going to go into the Fed's decision. Are we going to see higher inflation next year? Is it going to start to dissipate because the supply chains start to get worked out? Right. So there's a lot of things that go into, are these rate hikes going to happen next year? But the market is always forward looking. Right. So the market's looking normally about 6 months out into the future, trying to determine how is this going to impact companies. And so like this week in the market, you see a lot of scrambling going on. Right. You see the movement, the continued movement away from the COVID darlings, if you want to call them that. I mean, the stay-at-home stocks, those have come way down from their previous highs. The Zooms, Roku, who else? Peloton. Those kind of names have come way back down. You see it starting to happen with your, service as a software as a service companies, right? Adobe, Salesforce. Just all these subscription-based service companies, and you see more of a movement towards companies that actually make things, companies that are kind of the old stalwarts that have a lot of cash on their balance sheets. And so when you look at your portfolio and the portfolio that you want to design, you have to take this into consideration on what's going to happen over the next couple of years. And so, my advice, which, as we go here, my advice, but I am not your financial advisor. This is for entertainment purposes only. So do not buy or sell anything based solely on what you hear. Consult your financial advisor, and remember that past performance is not indicative of future results. So I never know when to put that in, but I guess any time is a good time. So when you're looking at your portfolio, you have to think about, how am I going to reposition my portfolio? What do I want to have happen? Well, looking at market history, it tells us that the returns over the next 5 to 10 years are probably not going to be as good as the returns over the previous 5 to 10 years. When you're in an environment where the Fed is lowering interest rates, it frees up money, and it allows, companies and people to be able to borrow money, put that money to work. And so in a rising interest rate environment, if we truly go into that makes it a little bit more difficult, and it also gives stocks competition. So when you're thinking about repositioning, you have to think about, what kind of companies do you own? You go back to previous episodes that we've had on this. Do you really understand the companies that you own? Do you understand how they make money? Do they have some kind of competitive advantage? And also, in a volatile market, you want to make sure that you're not trying to be a hero and buy in all your shares at once. Right? A better way to do it is to buy in stages. So if you want to have a position in company X, whatever it is, you have to be willing to say, okay, I'm willing to buy shares here, but if it drops, I'm going to be willing to buy some more. Right? And this is when dollar cost averaging really becomes a friend of yours, because you're never going to be able to time the exact bottom. You're never going to be able to time the exact top. And, you have to be okay with saying, okay, if this company drops a little bit, I'm going to be willing to buy more, and not just panic and sell it. So you really have to be comfortable with the companies that you want to hold. In addition to that, you also might want to look for companies that pay dividends, because if we do go into a period where we have muted returns, lower returns, then you want to get paid to wait. Right? So companies that pay you dividends essentially are paying you to wait, or paying you, while you own the stock. And so having more dividend-based companies could be the answer. And so, who benefits from higher interest rates? Well, one of the main beneficiaries of higher interest rates would be banks. They're allowed to loan money out at a higher rate. They're going to be some of the first companies that profit from it. So, look at what kind of financial companies do you own? And it doesn't mean that they're going to take off right away. You saw this week we had a couple good days. We'd have one good day, one bad day, one good day, one bad day. And so what that tells you is that you have, there's a lot of movement going around. Nobody really wants to hold anything overnight, with these rapid traders. They're trying to make some money during the day and not sell and not hold them overnight to see what happens. And so every time we have a good day, you have people that sell off into the good day. So we do need the market to steady out here. Normally, the last 8 trading days of the year are normally pretty good. It's called the Santa Claus rally, right? Normally that's what happens. I don't know if we'll have that this year. We'll see. In the next couple of weeks, I'll check back with you and let you know. You'll be able to see it if you're watching the market, but normally there's some kind of Santa Claus rally at the end of the year, and we'll see if that happens. But, looking at your portfolio, looking for companies that make things. So that would be like who would that be? That would be companies such as Johnson & Johnson, Starbucks, McDonald's, could be Cummins diesel engines, could be, Union Pacific Railroad. Those kind of companies that have real earnings, that are going to have earnings today. So again, I talked about this in previous episodes if you didn't listen to it, but one of the problems with rising interest rates is that companies that are not expected to be profitable till in the future, right? Maybe they're 2 to 3 years. Maybe they're 2 to 3 years away from profitability. It makes those profits that they have in the future worth less today. So that means their multiples are going to come down. And you've seen that happen with a lot of these names already. Now, it doesn't mean that they're bad companies, and it doesn't mean that you can't invest in them. But I'm just, understanding why they're coming back is a big deal. So now, if inflation actually comes back into check and it isn't near as bad as some investors think, those companies should take off again because they're going to be innovative. They're going to be able to grow at a pace that other companies can't touch. So, it doesn't mean that you get out of them completely. You might just lower your exposure to them for a little bit and move your funds elsewhere, right? So again, it just comes back to repositioning your portfolio, maybe making it a little bit safer. And I mean, that's really where kind of the art form comes in place, right? So, be cognizant of that. And when you're looking for new companies to look at, you can go through and see, okay, which one of these companies am I going to be okay holding for a long period of time? You also need to understand the impact that higher interest rates have on bonds. So especially like a 30-year bond, which I know sounds like just forever away, but a 1% increase in interest rates drops the price of a 30-year bond by 17%. And I know that just sounds like a crazy number, but you have to think of it in this case, and I know a lot of my students are going to be like, oh my gosh, the bond conversation. But if I have a bond that pays 1% and you can go out and buy a bond today that pays 1.5% or 2%, why would you buy my bond when you can go get one that's going to pay you so much more? The answer is you wouldn't. I'm going to have to discount that bond in order for you to purchase it from me. And that's how much on a 30-year bond I'd have to discount it for you to want to then entice you to buy it so that you would get the same, the yield equivalent. And so that's why when you have rising interest rates, if you're going to buy bonds, you want them to be short duration, 5 years, 10 years, something like that, so that you can get that principal back and then reinvest it at a higher rate. So you'll start seeing investors do more bond ladders, things of that nature, so that they can receive that principal back and reinvest it at a higher rate. So you'll start seeing that adjustment happen as well. And so something we don't talk about a lot on here, but we've mentioned it a couple of times, but exchange traded funds, ETFs, right? If you're kind of exhausted thinking about having to analyze individual companies, analyze individual stocks, you can always invest in the indexes, right? You can invest in the S&P 500, the NASDAQ. You can invest in the Dow Jones. That would be the SPY, the DIA, the QQQ. Like investing in these indexes is kind of hitting the easy button, where you're basically with those three, you're basically investing in America and saying, okay, I want to be an investor, but I don't want to do all this work. This seems like a lot of work. I don't want to do all this work. So you can do that. There are exchange traded funds, ETFs, for a number of things. If you want an ETF on just technology, if you want an ETF just on pharmaceuticals, if you want an ETF just on utilities, if you want an ETF on communications, if you want an ETF just from a certain country, you are able to find those and to be able to do it, right? And a lot of the ETFs and mutual funds, I prefer the ETFs because they don't have the fees, but even in your 401ks, right, or your retirement accounts, those are the choices that they're giving you. So there are ways to invest and not have to do all the work of, individual stocks. Individual stocks can be very hard. Individual stocks are great when the market's doing well. But once the market starts to get choppy, I mean, this is when you really have to pay attention to, do I know what I own? Do I know how they make money? Are they going to be able to keep making money? And do I own too much of it? Is it too much pain when it starts to go down? What percentage for me is correct, right? So, all those things start to get magnified when the market is starting to become more volatile. And that's kind of like my cautious case to you. You don't have to pick one or the other. you can invest in ETFs and say, okay, I'm going to own the SPY, the DIA, the QQQ. I'm going to own a little bit of that. That's going to be my, basically the pillars of my portfolio. And then I'm also going to own some individual stocks that I'm okay owning for the next 5 to 10 years. And if they were to drop, I'd want to buy more. Right? So that's really the key. If you go and you look at the stocks that you currently own, if they were to go down a little bit, would you be okay buying more? And if the answer is no, then you really need to evaluate, is that something that you really want to, that you should really be owning, right? So, take that into consideration, when you're looking at your portfolio and deciding, okay, if, is this something that I really want to be, held to over the next year or so? And again, when you're looking at, the sectors that do the best in times of inflation, energy tends to do well, banks tend to do well, some tech tends to do well, and then also big pharmaceuticals like the Johnson & Johnson that I mentioned earlier, companies whose the demand doesn't really sway based on what's happening. No matter what happens with inflation, we still need oil and gas and got to put gas in our cars. Banks are going to be doing well. And then technology stocks because, some of the bigger technology stocks because they have so much cash on their balance sheet, but they also don't have a lot of expenses and don't have a lot of loans or a lot of debt. Sorry, not loans, but they don't have a lot of debt on their balance sheets. So think about those. And, we only have 2 weeks left of the year, right? We got 2 weeks left. So think about last week's episode, working on your goals for 2022, thinking about how much money you want to save, how much money you want to invest, all of the things that you're thinking about as we head into this holiday week. Continue to think about what you're grateful for, what you're thankful for, the skills and abilities that you have and the things that people and things cannot take away from you. I appreciate this year. One of the things I'm grateful for is starting this podcast, actually having an audience. It's much bigger than I would have thought in the beginning. And so I appreciate all the feedback and the help that y'all have given me. It's pretty amazing to see already some of the opportunities and things that have come up from it. A lot of it's just getting closer to some people that I've really enjoyed over the past couple of years. So I am very, very thankful and grateful for this ability and the opportunity. So I hope you have a great week with your family and that you're able to kind of reflect a little bit because it isn't just about the stock market and all that entails. It's about being grateful and reflecting on all the things that we have that are going well for us. So I appreciate your time. A little bit shorter episode this week, but I do appreciate your time. I appreciate you listening. I appreciate you sharing this, and have a great, productive, and reflective week. And I'll see you next time.